Welcome back to Smart Stock Sam, the channel where I cut through the noise and follow the money. Today, we're tackling the question every investor is asking. Is Microsoft's post-earnings crash a once-in-a-decade buying opportunity, or is this a value trap that could drag your portfolio down with it? I've got revised price targets, institutional positioning data, and a technical setup that tells a very specific story. Stay locked in, because what I uncover today might completely change how you see this stock. Here is the paradox that should have every investor paying attention. Microsoft just delivered what Wall Street calls a double beat, crushing expectations on both revenue and earnings in the same quarter. Revenue came in at a staggering $81.3 billion, up 17% year over year. Non-GAAP net income, $30.9 billion, a 23% jump. By almost any measure, this is elite-tier performance. And yet, the stock has been absolutely crushed, down 27% from its highs, falling from $553 all the way down to $401. How does that happen? One hidden metric buried inside their capital expenditure report explains this entire sell-off, and we'll get there very soon. Now, before I reveal that shocker, let's do a proper anatomy of these earnings, because one specific $10 billion item is distorting the entire picture. On the surface, GAAP net income looks like it exploded 60% to $38.5 billion. But don't let that headline fool you for even a second. $10 billion of that figure came from a one-time OpenAI recapitalization gain, a paper win that will never repeat. The number you actually need to anchor to is the non-GAAP EPS of $4.14. That's the core operational heartbeat of the business, and it is still growing at 23%. Microsoft is essentially a cash printing machine. But as any seasoned investor knows, the market doesn't trade on yesterday's wins. It trades on tomorrow's fears. And those fears are starting to crack open inside Microsoft's two biggest divisions. Think of Microsoft as two very different companies right now. First, you have the intelligent cloud, still an absolute monster, pulling in $32.9 billion, up 29%. But here's where it gets uncomfortable. Azure growth slipped from 40% down to 39%. In the hyper-competitive AI arms race, even a 1% deceleration reads like a warning signal to analysts desperate for acceleration, not stabilization. On the other side, the more personal computing segment is becoming a genuine drag, actually shrinking by 3%, with Xbox content and services dropping 5%. The consumer hardware cycle is contracting, leaving the cloud engine to carry the entire weight of this company's valuation. Could that engine be running low on fuel? That brings us to the real culprit. This is what I call the capex shocker. And this single data point explains the entire sell-off. Microsoft's capital expenditure surged a mind-blowing 66% to $37.5 billion in just one quarter. They are deploying tens of billions on GPUs and CPUs, building the AI infrastructure they believe will dominate the next decade. The market's reaction? A brutal 10% single-day plunge on January 29th. Investors aren't arguing that the vision is wrong. They are demanding proof that the return on investment is real, and they want it now. It's the classic, build it, and they will come gamble. But what if they don't come fast enough? That fear has ignited a full-blown tug-of-war between the institutional giants who own this stock. On one side, you have the active managers, firms like Goldman Sachs and Bridgewater, trimming exposure by as much as 10%, locking in profits and reducing risk. On the other side, the passive giants like Vanguard are quietly increasing their positions. But here's the move that should make every contrarian lean forward. Soros Fund Management just increased their Microsoft stake by a staggering 158%, 158. While the crowd panics, they are building a high-conviction strategic position. With 83% of the float controlled by institutions, these titans are the ones who will ultimately decide where the floor is, and one of them is clearly betting it's right here. Since that January 28th earnings report, it has been nothing but red. That 10% single-day collapse was a valuation reset. Active managers hitting the exit at the same time. The stock has steadily bled from $553 all the way down to $401.32. This isn't a dip. This is a full-blown correction. But here's the thing about corrections. When a stock falls this hard, the sellers eventually run out of ammunition, and when they do, the only direction left is up. The charts are now telling a fascinating story. On the surface, nearly every momentum indicator is screaming strong sell. But for contrarians, that is actually the green light. The RSI has dipped as low as 32, pushing into deeply oversold territory. Look at how far the price has disconnected from the 200-day moving average, sitting at $444. Historically, when a high-quality blue chip like Microsoft gets this detached from its long-term average, mean reversion isn't a question of if, it's a question of when. And the $400 level is no random number. It is a psychological and structural line in the sand that smart money is defending aggressively. And the options market is confirming exactly that. Despite the price collapse, the put-to-call ratio is sitting at 0.52. In plain English, for every one person betting this stock falls further, there are nearly 2 people betting it bounces. We are seeing a massive concentration of 18,000 call contracts stacked at the $400 strike. Market participants aren't just hoping for a recovery, they are putting real capital behind it. This is textbook bullish divergence, price going down, but conviction going up. Could this be the calm before a serious snapback rally? Now let's talk about what this company is actually worth. Microsoft is currently trading at a price-to-earnings ratio of 24.99 times, its lowest valuation since the very beginning of the AI revolution. Their return on equity sits at 0.39, which is elite-level capital efficiency. But here's the hidden gem most retail investors completely overlook. The remaining performance obligations, or RPO, stands at $625 billion. That is guaranteed, contracted future revenue already sitting on the books, waiting to be recognized. Add to that a negligible short interest of 0.79%, and you have a picture of a stock where the aggressive bears have essentially already left the room. Before I share my trade setup analysis, a quick and important reminder like always. Everything discussed on Smart Stock Sam is purely for educational and informational purposes only. Nothing here constitutes personalized financial advice, and my analysis must not be interpreted as a recommendation to buy, sell, or hold any security. Always conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions. Markets carry real risk, and past performance is never a guarantee of future results. So here's my trade setup analysis. The strategic entry zone sits between $395 and $401.50, right on top of that institutional support floor. Expect some short-term friction in the $410 to $415 resistance band. But zoom out, and the picture gets genuinely exciting. The conservative bear case target puts Microsoft at $454. Our proprietary fair value estimate sits at $463, and the broader analyst consensus places the one-year price target at $612.29. That is a potential 55% upside from where the stock sits today. What would it mean for your portfolio if you were positioned before that move? Here's the bottom line. Microsoft is not a broken company. It is a company in the middle of a massive, deliberate structural transformation, spending aggressively today to own the future of artificial intelligence tomorrow. AI fatigue has temporarily crushed the valuation multiple, but the underlying business fundamentals remain completely intact. The active selling appears to have exhausted itself against the steady floor being built by index funds and high-conviction players. With a bullish options profile, deeply oversold technicals, and $625 billion in contracted revenue on the books, the $400 level represents a compelling entry for patient capital. Microsoft isn't broken. it's on sale. And on Smart Stocks, Sam, elite quality at a dislocated price is exactly what I hunt for. If this breakdown gave you an edge today, hit that subscribe button right now, because I love breaking down the stocks and setups that actually matter before the crowd catches on. Stay disciplined, protect your capital, and I'll see you in the next one.